At this point, I'm assuming you already know what's been going on in the market. With the closing of Silicon Valley Bank, it's been spreading a shockwave across the whole market, and financials have seemed to be suffering the worst. Not to mention, a couple more banks appear to be under a lot of stress, including First Republic. Everybody's got an opinion on this situation. If you type in Silicon Valley Bank in YouTube, you'll get a whole bunch of different opinions, ranging anywhere from it's the end of finance as we know it to everything's going to be just fine. Obviously, the markets are going to be volatile for the next few weeks and probably longer than that. I would like to add a few things which are really going to be more like reminders, since I'm sure nearly all of us have lived through many recessions, bear markets, and seasons of volatility like this. Silicon Valley Bank was not a consumer bank. It wasn't the kind of place where you could just walk in and open a checking or a savings account. They catered their services towards business accounts within the tech sector. With this in mind, SVB was not like your typical financial institution. The companies that are going to be most impacted by this are going to be tech companies. A worst case scenario for most people would be if you happen to work for a small tech startup, then there could be a disruption. But as we already know, the FDIC already took control of the bank on Friday, who as of the making of this video are trying to find another bank to acquire their assets. If you've ever been curious about what happens when the FDIC steps in, there's a really good episode of 60 Minutes here on YouTube that actually shows the steps that are taken when a bank fails and the government takes control. The FDIC can close the bank completely and liquefy the assets like the buildings and the financial holdings and use the proceeds to try and completely pay back the depositors. But the overwhelming majority of the cases, they actually try to find another bank that's willing to buy the business. This happened back in 2008 when Washington Mutual failed. Chase Bank stepped in and bought the bank, which resulted in everything being rebranded to Chase, and although there was a lot of panic, the disruption in service to consumers was only temporary. Remember, since the 1930s, the US has been through this same story many times over, and it's never resulted in the end of the stock market. Since the Great Depression, the United States has been through 14 recessions, and we've always recovered from them. If we go back to this graph that I show pretty often, the market always marches upward over time. There's periods where it can flatline or take time to recover, like during the 2008 financial crisis, but it always moves upwards. This is another reason why I like to invest in dividend stocks. Even when share prices are falling or flatlining, dividend payments will always still keep coming in. It can ensure that you're still receiving profits during times when share prices aren't increasing. But even though the market as a whole always moves upwards, there's always plenty of companies that do fail over time, which is why it's important to diversify what's inside your own stock portfolio across different sectors and holdings. And although the news on Silicon Valley Bank might lead you to think that it won't have much of an impact on dividend investors, since startups and tech companies typically don't pay dividends, it has impacted a couple holdings that I want to talk about today. The news regarding SVB impacted pretty much every company in the stock market, but even more so for companies that are involved in financing. This includes mortgage REITs, for example, where we've been seeing a lot of these companies' share prices fall by a much larger amount than the market. Over the last 5 days, the Dow Jones Mortgage REIT Index has fallen by over 9.4% compared to the S&P 500, which has only fallen by a little over 4% over the last 5 days. But there's two business development companies that were heavily impacted by the news regarding SVB that I want to focus on, both of which I hold and I talk about on a regular basis. The most concerning one would have to be Hercules Capital, which is ticker HTGC. As of the making of this video, this company's stock has fallen by over 25% in just the last 5 days. The reason for this is because this BDC specializes in providing financing to venture startups within the tech and life science sectors, both of which were negatively impacted by the closing of Silicon Valley Bank. It's been scaring a lot of investors who are concerned that these startups Hercules invests in might not be able to pay them the money that they're owed. And seeing their share price fall has been pretty discouraging. Hercules has always been one of the best performing business development companies out there for many years. They're one of the few that offer growth in this sector, and they've continued to increase their dividends and pay out a lot of special dividends. They've also been posting great financial results all throughout this season of high interest rates. But on Monday morning, the company published a press release regarding the situation. It says Hercules Capital is working collectively with our employees, stockholders, stakeholders, bondholders, rating agencies, portfolio companies, and our portfolio companies' venture capital and private equity sponsors to navigate the challenges created by the FDIC's decision to place Silicon Valley Bank into receivership. We are vigilantly monitoring this evolving situation and are fully committed to supporting venture and institutionally backed growth stage companies as they navigate this unprecedented environment. To point out some more highlights from this story, they also go on to say, the work that we have done over the last several years to expand and diversify our platform and team, enhance our liquidity, and strengthen our balance sheet has put us in a unique position of being able to play a leading role in working with many companies that have had a lending and banking relationship with SVB. As an initial step, we have earmarked up to $50 million of capital to provide select companies in our ecosystem with secured short-term financing to be able to meet payroll and other related obligations as a result of the closure of SVB. Hercules has enjoyed a competitive and collaborative relationship with SVB throughout our own 18-year history, and we have partnered with them on a variety of lending transactions over the years. We do not, however, hold any cash or cash equivalents or have any direct banking or operational relationship with SVB, and we do not expect any direct impact on our day-to-day operations as a result of SVB's closure. By contrast, we continue to experience ample liquidity and capital availability, a strong balance sheet, and a diversified portfolio positioning. From this position of strength, we stand ready and willing to help the venture and growth stage community. Hercules ended 2022 with over $3.6 billion worth of assets under management, which was an increase of 29.3% year over year and a strong liquidity of over $606 million. As of Monday, Silicon Valley Bank customers have full access to their funds thanks to the government creating a bridge bank. There's one more BDC that did suffer more than usual, although not as bad as Hercules Capital, which was Triple Point Venture Growth, ticker TPVG. Their stock is down about 13% over the last 5 days, but on Monday it did recover 3.5% unlike Hercules. TriplePoint is another BDC that focuses on tech startups in a similar way to HTGC. As of the making of this video, TriplePoint doesn't appear to have any kind of statement regarding this situation, which I think is pretty unusual, but investors appear to be more optimistic about this stock anyways yesterday. Again, this whole thing is changing daily, and the news that comes out tomorrow could greatly differ from today. It's still too early to tell if this news is going to result in any stocks getting a dividend cut, but at this time I don't see that would be necessary. If SVB clients are able to access all their money, then they can still pay their employees and their loans. If anything happens, it's going to take months until we know the full impact. While these regional banks have been suffering all week, the much larger banks haven't been suffering nearly as much. If you want more information on how exactly SVB failed, I'd recommend watching a video by a guy named CoffeeZilla. He explains the whole thing in easy to understand language. As for me, the news hasn't changed my opinion at all on either of these two stocks, even though I'm now officially in the red on both of them. I'm not selling anything because I believe the news on them is completely overblown. My portfolio is so diversified that if a dividend cut were to occur with either of these companies, it wouldn't be too dramatic for me. Which again, I always recommend that everyone diversify their portfolios, especially during times like this. With that being said, thank you all so much for watching today's video. Remember, don't panic and start selling everything. Creating panic is what can send markets tumbling, and I still believe that everyone's overreacting to what's going on. I'll keep you all posted on this situation if there happens to be any dramatic changes. Again, thank you all so much for watching, and until next time, stay calm.